Hi, my name's Will.
And I'm Ed.
We work on the officials, where we publish fair value curves across oil swaps at the close of European and Singapore sessions each day and provide a bit of commentary on forces driving the market. Today, we're going to discuss some of the recent Saudi Aramco allocations into China, as well as the Saudi OSPs that have come out recently. They've been pretty interesting. So, Ed, what have you seen on the allocation side?
Yeah, so the allocations came in at a total of 47 million barrels. So if you look at the chart that I've got on the screen, it's not changed particularly from the previous month for the June allocation, but it remains very high on a historic basis. So over the past 12 months that we've been publishing the officials, the last 3 months have each been the top three highest monthly allocations that we've seen. And this is bouncing off the very, very low allocation in April of, I think, 36.5 million. So the allocation that they've provided has gone up significantly. Within that headline statistic, there's been a bit of chopping and changing. So Rongsheng, for instance, got a slight cut. PetroChina and Unipec were up and down. Hengli had some more. So there is variation on the monthly basis, but overall it looks very strong. And I think the stability narrative that the Saudis have been pushing has really come across in this set of allocations.
Yeah, I mean, I think as we'll unpack in a bit, a lot of this has to do with Saudi OSPs, but it also gives you a little bit of a flavour about what's going on in China. What's the demand like in China?
Yeah.
So, I mean, we know that China like to buy opportunistically on a flat price basis, so it makes sense when flat price falls, they're going to start building inventories, and we've seen that.
They are, yeah.
Recently, inventories in China have grown to record levels.
Yeah.
At the same time, we're seeing quite low run rates in China. We're seeing, state-owned refiners at around 77.5%. Independents are at 63%. Shandong independents are now running sub 50%. We know there's some big turnarounds there. Is this a reflection of demand, do you think, in China, or do you think what do you think that looks like in the broader context?
Overall, I think it is a lot to do with the China policy of pursuing energy security. Yeah. We've seen them recently, over months even, they have been buying when flat prices come down. When we got near to 70 in previous months, they would come into particularly the spot market, buy a lot of crude there.
Classic Chinese put
exactly.
$70.
And now we're in the 60s. We've been here for over a month and a half now. So really it makes sense that they are trying to buy as much as they can while prices are this low, potentially with the risk of prices rising again and increasing costs for imports, which are where China gets most of its crude from. Yeah,
of course. And you also have to remember that the yuan is being devalued on a dollar basis and the dollar's weak. So, that imports are going to be getting more expensive for China if they do pursue a more export supportive foreign exchange policy. So we know that they buy on a flat price basis opportunistically, and that has made sense recently because the OSPs up until the most recent batch had been pretty generous. They were cutting by more than the market structure would imply. They were hiking by less than the market structure would imply. And this is kind of, it's more of that incentive for Saudi Aramco to get their barrels out. And it was sort of starting to set the tone of is there going to be a price war?
A push for market
that's
share.
What lots of people were thinking, and then OPEC were announcing the unwind of their voluntary cuts, and a lot of the market was seemingly getting ready for this huge outflow of OPEC barrels coming from Saudi Aramco. But the recent OSPs don't really convey that at all, do they, Ed? Like we saw, do you want to go through what we saw?
Yeah, so as we explained in our previous Dubai explainer, and make sure you go and watch that once we finished here, the Dubai structure in May trading suggested a cut of around 35 to 40 cents based on the change in the average physical premium month on month. But in fact, the Saudis cut their benchmark Arab Light into Asia OSP by 20 cents month on month. So that indicates perhaps, they're not being as aggressive in terms of the market share policy that they've been pursuing. And I think that's reassured the market really, because there were growing concerns that Saudi Arabia particularly would be opening the taps and pumping a lot more. And I think the market is waking up to the fact that OPEC quotas don't reflect reality.
Yeah, for sure. And so part of it, I completely agree, is that you have a Saudi Aramco that wants to convey unity and wants to convey a commitment to that market stability by not just releasing the floodgates. But then there's also another aspect here that we discussed a little bit before. So check out our video on Dubai and Murban. Murban had been actually setting the floor on the Dubai benchmark. And Murban's a pretty different grade, isn't it, to Saudi Light? Saudi Light is much more closely comparable to your Upper Zakhams or your Omans, your more traditional medium sours. And if they're all pricing above Murban, it then makes sense for Saudi Aramco to maybe not set their OSPs quite as the Dubai structure would imply if it's Murban that's setting that structure. So there's a number of different things, and also perhaps they just want to regain some of that generosity that they had been extending over the previous few months. We've seen more and more debt issuances coming out of the Middle East recently, which that conveys a certain image that perhaps the generosity might be coming to an end.
Previously it's been a policy of spend, but now they're clearly not in such a luxurious position. But I would like to add to your comment on Murban that we also had the ADNOC OSPs, which are for Murban, which is set off the average settlement of IFAD Murban futures through the month as their kind of baseline, and then they set Upper Zakum, Das, and Lulu as a differential to that. And for their July OSP, they set Upper Zakum at a 10-cent premium over Murban. So we're still seeing this strength in medium sours for now. However, with the changes to the Murban export schedule, cutting back on Murban production, running more of it domestically within the UAE at the Royce refinery, that will be an interesting one to watch in next month's OSPs, because I think it's quite likely we'll see a flip again where we see Murban at a premium to Upper Zakum rather than the other way around.
Yeah, we might start to slowly see a return to that normal pricing hierarchy. But there's going to be one factor that kind of blocks that, and that's if fuel oil stays strong. We know that Saudi Aramco burn about 400 kbd of crude during the summer for power generation. That's gonna limit the amount of medium sours on the market.
Well, if you consider that each month with these kind of extra hikes of 411 to the OPEC quota, Saudi Arabia's been doing 167,000 barrels of that. And if their summer demand for crude burn is 400,000, that immediately wipes out all of the additional quota they've been given anyway. So it doesn't mean that these barrels are coming back to the market, because there are other dynamics at play.
Yeah, and as long as Sing 380 stays strong, I mean, we've seen it start to come off recently, but we're still far from where it was pricing when Upper Zakum was kind of the deliverable grade. So if that remains strong, then we could see a continuation of this rather unusual pricing.
But, I suppose the other question is really the China demand story, because last year particularly China's demand was the big concern, that China wasn't growing as expected, that its oil demand was lackluster. That seems to have eased somewhat this year. I wonder if you have any thoughts on that particularly.
Yeah, I mean, China has been kind of the big question mark in the global demand story for a long time. You see analysts kind of flip-flop back and forth. There's growth in China, there's no growth in China. It's a hazy picture to kind of unpack. I think for me, the core root of the issue is, of course, the property market, and the collapse of Evergrande in 2021 really kind of catalyzed that. We're starting to see some of those property sector indicators bottom out. So we're starting to see property prices increase in some regions around China. We're starting to see the rate of decline in floor space sold slow. And the Chinese government is pretty liberal in its stimulus, to say the least. And they're announcing more and more. And we saw kind of last week there was the Caixin Services PMI, which printed softer than market expectations. And then we saw the CSI rally on the news. It's kind of that's
bad news is good news because it's not as bad as it could have been.
Because it's not as bad as it could have been, but more that it's therefore supportive of more stimulus.
Right.
So we saw it back in back last year with the Fed, where you get a weak PMI print in the US, and that means the Fed has to cut. So therefore equities rally. It's the same story in China. But I think China will take a they'll throw the kitchen sink at it. They need that 5% growth. It's very, very important to the CCP. And we're seeing local government issuances up. So I think, the outlook in China is actually, on the balance of things, in my view, looking a bit more positive for once.
I would generally agree, I think. So on the whole, we've had some interesting OSP releases, a pretty standard allocation that we were really expecting. I think the market wasn't shocked by. And then perhaps a bit more positivity on China, especially if the trade deal that's just been agreed today seems to make some ground and stabilize the trade relations with the US. So on the whole, I think the market is probably looking stronger than it has done for a while.
For sure. Definitely more constructive.
Yeah, agreed. So that's all from us this week. So thank you for watching. Make sure to like and subscribe. And remember that you can find all of our daily reports on Jorge's LinkedIn, on our Flux.live page, or our Twitter account, which is @OnyxOfficials. So make sure you go and follow us there and keep up to date with everything we're doing. And we'll see you in the next video.
Thank you very much for watching.